I'm just going to wait a couple minutes and see if the anybody from the retiree group joins in, and then we'll get started.
Good afternoon.
I don't see anybody else joining, so I'm going to go ahead and get us started. I think the purpose of today's meeting was to talk with Larry from Gallagher and his team regarding the study that we had talked about engaging in. And I think in our last meeting, there were some concerns about what we actually wanted as deliverables from this study, and thus having Larry and team on the call. I think it would be a good thing for us to be able to articulate to them what we're looking for so they can clearly understand what our needs are, and then we can evaluate following that if we decide we want to move forward. So with that, Brad, I'm going to put you on the spot because you speak their language better than I speak their language, about kind of what we're overall looking for. I've already sent it to Larry, so he has an idea, but maybe if you could just kick us off with that, that would be helpful.
Yeah. Can everybody hear me?
Yes.
Okay. I wrote the most eloquent email ever to Kathy describing what we wanted, and I'm slowly pulling it up here. Okay, so let me read this here. Okay, so we've had plan reviews in the past. I don't think we've had kind of an in-depth review since the plan got to its current status, which is close to active members, shrinking, evaluating the right way to sort of maximize retirement income and improve retirement outcomes for the participants we have today. It's got a much higher retiree to active ratio. We're in a new higher interest rate environment than we were, 10 years ago, the last time we would have had kind of a deep dive like this. So succinctly, I guess it's maybe time for a more in-depth review of what our investment strategy is to make sure it's aligned with what our goals are. We're no longer predominantly going to be helping active members get to the right retirement phase. It's going to be kind of a combination, more weighted towards making sure the retirees' income is safe while at the same time making sure the actives can achieve the retirement outcomes that they need, that we're seeing good account value growth. The plan also, I think, needs to improve its funded status over time. So I think an understanding of how different investment allocations could help us achieve that goal would help. Understanding which environments are going to be beneficial, which environments could be challenging for different investment strategies. We just want to make sure we have kind of a robust strategy going forward that'll both protect the retirees' income and also help the actives achieve the best outcome possible for them across a wide variety of scenarios. Something that makes this plan kind of funky and unique is the excess earnings mechanism. I'm sure you're aware of that piece. So as you think about that objective of helping the actives sort of achieve the best outcome possible with this plan, I almost feel like the excess earnings mechanism sort of hinders that in a way, because if you have an upside market, which you count on a handful of like extreme upside years over the course of an active member's path from starting to work in the plan to retirement, to sort of support the 8, 10, 12% equity return that you see over time. If you're capping that because of the excess earnings mechanism, what kind of an impact does that have on the retiree's outcome? And is the best path forward to look to maximize income in this plan, or is it to supplement it with a 403b or another plan on the side of that? So I'm starting to ramble a little bit. I got away from my beautifully worded email that I wrote to Kathy, kind of outlining what our objectives are. But overall, I think we want an analysis of where we are today, what the best investment strategy should be on a go-forward basis. The main question being, what's the right allocation to fixed income investments given the new rate environment, and equity investments. If there are other alternative asset classes that could help diversify and produce a more stable or robust growth path, that'd be helpful too. But just understanding, given the current demographics and the projected demographics of this plan, what's the best strategy going forward? Because I think our current strategy is more geared still towards assuming we have a steady inflow of actives, and the ratio between actives and retireds doesn't change materially over time. So I rambled a bit there. Any clarifying questions that I can help address?
I don't think so for me, but I'm going to, first thing I'm going to do is, I think everything you said is something we hear a lot from plan sponsors, especially we have a lot of frozen plans going towards, being retirees, and you still want to, have the benefits there for the actives that are still active. One of the people I brought today is Chris Snell. He is somebody that really does this type of study. That's his specialty, and his group does this all the time. So I'm going to let him kind of speak a little bit more on some of the ideas that he has, because, like I said, he does this on a regular basis. So, Chris, if you kind of introduce yourself and go ahead and kind of address some of the concerns he has.
Sure. Thanks, Larry.
Yeah.
And thanks for that background, Brad. I might have seen a copy of your eloquently worded email at some point. I've gotten some information from Larry, so but I do appreciate that backup. That was really helpful. So I'm Chris Snell. I've been in the industry and with the firm for about 15 years now. And like Larry said, I actually started as a traditional pension actuary, but I've spent most of my career in our investments practice, which is focused on these types of studies, asset liability modeling studies, we call them. So I do that for a lot of corporate and public pension plans. And they're just really interesting to me because they all kind of have their own objectives and strategies, like you laid out, Brad. And the structure we have around our asset liability modeling tools is made so that we can kind of customize it to get whatever you're specifically looking for. So that's what I've spent most of my career doing. And, we help clients from an investment advisory standpoint. We have retainer clients that we work with, throughout the year, and we do a lot of project-based work. So that's where I spend my time. And I've got slides to go through if we want to dive into any more detail, but I'll talk a little bit about, how we typically approach one of these studies, if that helps, and then just talk about kind of scope and timing. And does that sound okay?
Sounds great.
Okay. So yeah, I think one of the main parts of our process in running an asset liability study is really to work closely and leverage all the knowledge and experience that Larry has on his side, right? As your actuary for the plan, he's got all the details on the plan population, the data, the contributions, the asset balances, all that detail is necessary for us to set up what we call a stochastic forecast. So let me just ask, have you run projections for this plan in the past? I know, Brad, you said you kind of went through a review maybe 10 or so years ago, but do you regularly run projections otherwise? Okay.
Not to this level. We'd had a consultant maybe, how long ago would that have been, Kathy? Like 10 years or so ago. Wasn't an actuary. We were super dissatisfied with the quality of the work and the recommendation. So the bar is low, I would say.
Yeah, and I really think having that actuarial knowledge in these types of situations is key, because if you're just thinking about the investments and how the portfolio performs, that's really just one side of the equation. So that's why it's called asset liability modeling. So we are modeling both the assets and the liabilities on a projected basis. And just to set the stage, I say stochastic projection because we work with a lot of public funds that do what we call deterministic projections, which is you go out 10 to 30 years, whatever time horizon you want, and you have an assumption that the assets are going to return whatever you expect them to return, maybe 6% a year, 7% a year. And that's what your projection is based on. So when we do a stochastic projection, we're running actually either 1,000 or 5,000 different scenarios. And that is just all encompassing in terms of different interest rate environments and capital markets throughout the time horizon that you want to focus on. So it gives you that full range of results on how the fund will perform in pessimistic scenarios, optimistic, and everything in between. And we feel that kind of produces a powerful set of data for you to understand, if you were to shift 10% of your fund into equities, what's the probability that after 10 years, your plan is in a better place than it was under your current asset strategy? And in the cases where it's not in a better place, how much worse off is it? So I think that's what this type of projection provides, and it seems like that's the route you need to go to answer some of the questions that you have. Now those projects can be pretty intensive. Like I said, we're running 1,000 to 5,000 scenarios, and we've got to set that up to accurately portray your plan specific provisions, right? I know I am by no means today an expert on the provisions. I would rely on Larry to help with that, but we've got to make sure that we're reflecting that excess earnings mechanism that you're talking about, Brad, and that's part of this, if those are the questions you want answered out of this. So these projects do typically take 8 to 12 weeks to really fully go through a study like this. If there is more timing constraints, and if you had an idea on like when you need this for, let's certainly talk about it. But does that make sense, that it can be pretty intensive and take some time?
It does. I do have a question. You said it's anywhere from 1,000 to 5,000 scenarios. That's a big range. What determines if it's the 1,000 or if it's the 5,000?
Yeah, good question. For some instances, we feel that 1,000 is appropriate. I'm kind of leaning in this situation, just talking about how you really want to get a sense of, the range of results. 5,000 might be the answer. That doesn't make all that much of a difference from our perspective in terms of cost and timing, because we have tools that are able to run these. But so I would probably in this instance lean towards running the 5,000 scenarios. But again, it shouldn't impact, from a cost or timing perspective from you. That answer
Thank
your
you.
question?
Yes.
Chris, can you give me a better sense of what those 1,000 to 5,000 models, what does that mean? What are we talking about in terms of what's that look like on your perspective, and what's the tangible outcome that we would see from that product?
Yeah, so when I say let's use 5,000 scenarios, right? We are running. Let me ask you a question first. In terms of time horizon, do you think you're focusing more on like a 10-year projection or a 30-year projection? Any sense from you on that sort of time horizon?
I think when we talk about timing of this plan, because the plan is in its last stages, which still has, realistically, we still have a couple of, and I mean literally a couple of 30-year-old members that are in the plan, but realistically, 85, 90% of the plan members are in their 60s or 70s. And so I think, Chris, what we would want is that I don't know if 10 years is enough. I mean, I think probably you're looking at 15 or 20 years in terms of by that point, the vast majority of the plan members are going to be 80, 85, 90 years old. And at that point,
Right.
you realistically, you might have 10 members still left in this plan. And honestly, at that point, there's probably a totally different discussion about what that group actually exists. So I don't know
Yeah.
that I would say 10 years is the right number, but I think that probably pushing much past 20 or 25 is exceeding for us literally the retirement age of almost the body of employees in this plan.
Yeah, I don't think you need to get the last dollar out of the plan. But my thought actually is that 10 years might be okay because you have a pretty good idea of like, is my range of outcomes, is it here and now it's gone to here, or is it down to here? Or you'll have a pretty good indication of where things are headed. If that helps you control kind of like the data management or the cost on your end, 10 years is probably enough for us to infer which is the right strategy for us, or if there are any like catastrophic issues with one strategy over the other.
I think that's fair. Yeah. And, you know, in all honesty, this should be revisited by the time you hit 10 years from now anyway, right? Because like you said, markets change quickly. So, and the population is going to change over time. But I think from a 10-year perspective, that makes sense. And just to answer your question, Blake, so the 5,000 different scenarios, you essentially have 5,000 sets of projections for 10 years, and each one of those 5,000 trials is a different economic environment over the 10 years. So in one trial, you've got 10 years of asset returns, and throughout those 10 years, the asset returns are fluctuating with what could be a realistic outcome. And we do that 5,000 different times so that you're capturing. I can honestly say that probably what actually happens in the next 10 years isn't going to be exactly identical to any of those 5,000 scenarios, but you are capturing what we think is a realistic wide range of possible results over the next 10 years. Does that make sense? So it does vary from year to year in inflation, interest rate environment, equity markets, all of that. And then it's internally consistent, right? So if you've got interest rates rising over the next 10 years in one of those scenarios, you're going to see a fall in your fixed income portfolio value because of those interest rates rising.
Chris, what does the product look like that we see? Obviously, we don't want to see 5,000 scenarios. I assume that that's got to get condensed. So what's that condensed final report look like?
Yeah, let me see if I can pull up a quick sample and I'll show you. No, we would not make you look through 5,000, I promise.
That would make Brad's eloquent email look great.
How I think about it, Blake, is the stochastic result might tell you like the probability that somebody in your cohort could have a successful retirement. Scenario-based analysis is going to say, well, if there's a financial crisis, Blake's retirement is going to be bad. Or if equity markets return 20% every year for the next 30 years, it's going to be good. Whereas stochastic analysis might say, with this strategy, there's a 75% chance you'll be happy in retirement. Or with a different strategy, it's going to be 65%. So opt for the 75, right? Stochastic analysis can also kind of tell if you have kind of some funky policy features, which we do with the excess earnings mechanism, right? It can help uncover what are the specific scenarios where that funky policy provision can cause some issues, right? You might not be able to imagine if you have a bunch of different liabilities stacked up that have all these different characteristics and guarantees embedded with them when you're going to have issues, but you can identify, okay, scenario 3,421 has some issues. What happened in there? Oh, rates went up and equities went down. That makes sense. When did it happen? Well, it happened when the plan was at this funded status. It can help you kind of uncover some things that deterministic scenarios may not be able to help you understand. Chris, did I capture that okay?
Yeah, Brandon, that was good. And I'll have output I'll just pull up real quick and share. You're right. It's going to produce a range of results, but you can kind of cherry pick scenarios within that 5,000 to illustrate, you know, in this type of scenario, this is what happens. But the generic output is going to look something like this is a sample of funded ratio. So this shows 10 years, 20 years, 30 years, but let's just focus on the left section. This is 10 years out. And this is for 5 different investment strategies. So we've got a target allocation, a current allocation, and then different shifts into different fixed incomes. But you'll see like a bar graph, a range of results. So basically, the middle of these bars are the expected scenario, the base case out of all 5,000, and then you see, just how high the PBO, the funded ratio, can go, or how low. So presumably, if you have a scenario where you have 30% in equities, you've got a bar, and if you are going to increase the equity exposure, the range of results is going to get larger, right? Because you've got more equity risk. So you'll kind of be able to see how the range of results change, as well as how the base case and expected outcome changes with different investment strategies. That answer your question, Blake?
Yes, that helps. Thank you so much.
Okay. And I'll also add that I think we have generic output from the stochastic tools that we use, but I know based on some of the questions there might be some specific scenarios you want to pull, and just some specific types of output you would like to see based on your specific plan provision. So when I say 8 to 12 weeks to get this done, I think in this type of scenario, it may make sense to either meet with a smaller group or something halfway through or so, show you what we've got, and then talk about, if there's other things you want to see, if that makes sense.
So you mentioned that this is both asset liability modeling. How do the liabilities play into that then? Because like what you're talking about to me sounds more like the asset mix, and that you're projecting out what our balances would look like and what things would look like with the change in an asset mix. Are you then factoring in a change in our liabilities as well?
Yes, and Larry, keep me honest here. The way the liabilities are valued, you use the discount rate that is equal to the expected return on assets. Is that right?
Yeah, we've been using that for this plan.
Right. So presumably, something to think about is if you're changing your investment strategy. Certainly, if it's changing significantly, but we would want to keep that in mind. If you're changing your investment strategy, it may change the discount rate you use to value the liabilities. So we would be reflecting that in any significant changes to the investment strategy. And we're essentially taking cash flows from Larry and the actuarial team to value the liabilities, and projecting that out along with the assets when we're doing our 10-year projection.
And one thing Brad, you mentioned earlier was about the excess assets. Now, if you're going to go, just say you want to go to a riskier type portfolio where you've got more equity in it, are you going to, all of those assets going to be immediately taken out of the plan by, allocating them to current retirees? That then does it make sense to even put any more risk into the plan because you're getting there? So I think one of the big conversations we're going to have as we go through this, and you touched on it early, is what do we do with these excess assets? Because if we're trying to get the plan better funded, but then we're giving back all the excess earnings, and then so you're basically taking the losses, but you're giving away the gains. So it's going to over the long run, that's going to be hard to make a lot of room up. So yep. I think we do need to discuss that as kind of a plan design as we go through this.
Yeah, and to be clear, one of our goals, because we represent the retired members as well here too, is to make sure that excess earnings are high in most years, right? But we do want to understand how that impacts the active membership, and if it, to your point, makes sense to, try to improve active member retirement outcomes by adding more risk to this portfolio, or if we're pushing on a string in that regard, and it makes more sense to allocate extra funds to like a 403B plan where they can keep most of the gains for themselves. So I think that'd be insightful to kind of understand, does it make sense to keep trying to improve active outcomes with this plan with more risk, or is it better, more direct path to increase contributions outside of the plan for the active members? Keeping in mind, for the retirees, of course, we want to have continued high excess earnings as much as we can. I think it's really important to quantify through
Right.
time, how do the excess earnings change over time? How much cumulatively did it get over time? And if this is possible, kind of forecast out what the funded ratio is through time as well.
Right. Yeah, and I agree with that. You obviously, the plan here is here for the actives and the retirees. What I was looking at is, one of your goals too was getting the funding percent better. And, if your excess earnings are going somewhere, then the funding percentage is not going to, that's just overall, you're not going to make as much ground.
Yeah, they are capped. The excess earnings are, so like, I think it's the first 10% or so go to excess earnings, and then beyond that point, I think then it funnels into the plan. But then you need like several years of very high returns to make up for that. So there is some ground to be gained there, but it's almost like a reverse buffer annuity, sort of like where the insurance company eats the first 10%, and then the downside is the person who purchased the annuity. It's kind of the opposite, where the upside is the retirees for the first 10%. And then beyond that, it's kind of distributed to actives and sort of indirectly the taxpayer, right? But Barb, did you have your hand up for a second there?
Yeah, Mike, I just have a quick question about that. So with the excess earnings, we've always talked about that some of that money, extra money, also goes into the actives pots. Is that correct or incorrect? I mean, is there a percentage of money other than just what was earned annually that also goes to the actives from that? Am I wrong on that?
I believe you're correct. Y'all usually are the ones that do the excess earnings allocation, so I haven't looked at it in as much detail recently. But yes, I believe there is a portion of that goes to the actives as well.
Make two other points. Sorry, go ahead, Brad.
No, please go ahead. I was going to make an uninformed comment there, but go ahead.
Yeah, I was going to just make two more points I think worth making. When I mentioned like the 5,000 scenarios, we have a set of what we call capital market assumptions that we develop at Gallagher. So that is what we use to form those scenarios. Those capital market assumptions are generated at least annually by our investment team, and they reflect market conditions that are up to date, and then our expectation going forward, going as far out as 30 years. So that's what is generated to support our 5,000 trials that we run.
Can we share those with Bankers Trust, just to make sure they're kind of aligned with what they can deliver as well?
Yeah, we can send a summary of those assumptions so you have them. And I assume you have an investment advisor or some sort that's working with the plan. When we're talking about scenarios to run, we're happy to work in conjunction with them to develop those other scenarios, alternative scenarios, if you'd like, or we could recommend based on what we see what we think we should run. But just wanted to say that's a collaborative process that we're happy to involve whoever needs to be involved in. Yeah,
I think it'd be good to get the BTC team involved there. See, they're sharing a computer today.
Yeah,
I'm happy to be involved as well.
Jeff, feel free to send that to Kathy, and then she can forward it to us. So we can kind of, anyway, that makes total sense.
Ultimately, if you do make a change, the people that are implementing it should certainly be involved in the analysis. So that makes sense. Any other questions I can help answer or dive into in more detail?
One question I have, just roles in general, and I want to understand and see how you view it. Certainly our role is to manage the portfolio, and we think about it like we're managing a bond, fixed income portion of the portfolio, or managing the equity portion of the portfolio. We can certainly provide input into exactly what that asset allocation should be. But given the type of plan. It's really an ALM focused exercise. And so I think sometimes we feel like there's only a certain amount of the way we can take that without your input as actuaries on this. And so I don't know if that makes sense or not, but it's almost in this case, unlike other clients where we're almost relying on you to a large degree. We are relying on you to a large degree to say, here's what needs to be done based on what the liability side of it looks like. So I don't know if that seems fair or not, but do you think that's reasonable and fair?
Yeah, I think so. Certainly for this exercise, and I think as you know, if we're going to go down this route, we would get into a conversation about the scenarios to run, right? I think from some of the earlier emails I saw, maybe there's a maximum exposure of 30% to equities, if I'm remembering correctly, and the one alternative that was mentioned is maybe moving up to 40. So we would just kind of talk through, you know, I wouldn't want to run a scenario with 90% in equities if that's not a realistic option, right?
I mean, yeah, we've run scenarios before and we can certainly, do that again, but it's just, what we're missing or have been missing is we can provide, we don't know the liability side of things, and we can certainly provide, well, if you want to go up to 40% equity based on historical returns of equities, we can tell you what that expected return is going to be over a 10 plus year period of time, but we don't know how that matches up with what the liability side looks like. So that's kind of what would be really helpful from the BTC, from the our perspective. We seem like we can't quite finish the answer for the committee without the liability side of things.
That makes sense. And that's what hopefully this type of project will do, is put the full picture together. I mentioned not running a scenario of 90% equities if that's not realistic, but I will say it's probably worth running more than just 30 and 40. You may want to, push it out a little bit to understand, why you don't want to go to 50 or 60% in equities, just to see that, if that makes sense.
Yeah, that does. I mean, I think it's helpful to paint the whole picture, or as much of the picture as possible, rather than constrain it. I think seeing the potential tails of the situation can really build perspective.
Yeah, a lot of the times it's not perfect math, but you can linearly interpolate, right? If the difference between 30% in equities and 60% in equities, somewhere in the middle is 45% in equities, right?
Yeah, exactly.
So it's good to see a wide range.
I think 10% increments out to 60%, for example. Certainly that would be, I don't know if we need to go further than that, but if you want to go further than that, I think that's fine. But I think 60% is where my mind jumps to, is that should paint. Anything beyond that's probably getting really into unrealistic territory. And simply because if you have a 20% plus pullback in the market for a couple of years in a row, that's really that's a lot of underwater equities at that point. That'll create a lot of uncertainty. The market's always bounced back. It always bounces back in a matter of, it depends on how much time it's going to take to do that. And in the meantime, what stress is that going to put the plan under?
It sounds like the considerations are more so towards upping the equity exposure. Is there any value to running a decrease in equity exposure, or is that not the direction that we think we need to explore?
It doesn't seem likely that may happen, but I think, again, doing it, I would take it all the way back down to 10%. Or what the heck, if you're going to go to 10%, might as well go to 0 and show what that looks like too, because it'll build it builds perspective. I think it's not, it's not going to, it may not be realistic, but without seeing it, I can't say I can't say right here on the fly whether or not it might be helpful. It's obviously not going to be the answer.
Yeah.
Is it going to produce a good curve or not? That's what I'm getting at. And I don't know if it's going to produce a nice curve if you widen out the potential allocations. I don't know if it's going to do that or not. If it did, that might be helpful to see. That's all I'm thinking. And that's, the statistical side of this, my thoughts on it are pretty rudimentary compared to what yours are. So.
Yeah, I think if we want to move forward with just a proposal and outlining a scope here, I'd probably get back with Larry. We could huddle up and just think about scenarios. Like our basic scope typically includes a current scenario and then 3 alternatives. So we would kind of outline them along with the cost and timing. And then, like I said, we could kind of meet along the way. And if there's more you'd like to see or alternative scenarios, that could be something that we tackle along the way, if that makes sense.
Yep. One caveat to it is if you really do think that I think I want to do this in a way that's it's if there's fees for this and there really is low probability that there isn't much value to going to 0 or even 10% because it's not probably very realistic that we do, then I'd say let's skip that exercise and skip the associated fee with it. Because I don't want to be signing. I mean, I'm not the boss here, so I don't want to be signing up the committee and the plan for fees on this project that really aren't going to add value.
Yeah, that's why I say maybe we start with just kind of the baseline scope with the 3 scenarios, and then we can always word the contract in a way that allows for additional scenarios with added incremental cost if we need to go there. But that's typically how we started out.
Which software do you guys use?
So we leverage Larry's ProVal software, if you've heard about ProVal, like valuing the liabilities that way. And then we use a third party, we lease a software that develops our capital market assumptions on the asset side. And then we're able to kind of bring those capital market assumptions into ProVal and run a stochastic forecast that way.
Okay.
Makes it sound easier than it is, I promise.
Yep.
What's your
What's
current-
the second software you mentioned there? Is it like a Faro or what?
Conning. If
Okay.
you've ever heard of Conning. Faro, I'm very familiar with. We've had some discussions around Faro, but we have not gone down that path yet at Gallagher. But we've
Got it.
seen the
Okay.
tool a few times.
As long as we're not doing risk neutral analysis, I'm okay with using Conning. They ran into some issues with the Academy and NAIC back a handful of years ago, trying to develop a risk neutral stochastic generator that, I don't know. I forget all the details behind that, but they had some issues, but shouldn't be
Yeah,
pertinent to
Conning's
this
been
analysis.
nice because it's a sophisticated software, but I know our team has the ability to calibrate some of their own views and opinions in setting the capital market assumptions. So it's not, they produce an out of the box version, but we're able to kind of calibrate it with our views. So that's been good.
Makes sense.
Any other questions?
So off the cuff, you mentioned looking at less options and that would adjust pricing. Do you know how that impacts the pricing?
Yeah, so I'll just talk in our standard, pricing structure. Like I said, the current allocation and 3 alternatives typically about 8 to 12 weeks, and the standard pricing is in the $60,000 to $75,000 range for one of those types of projects. So I've got to kind of sit down with Larry and scope this out in a little bit more detail, but just so you're aware of the potential range of one of these. And then we could structure it in a way that allows for additional scenarios if that's desired. But we have lower scope versions of this, but just based on this conversation, I don't know that those lower scope versions are going to answer the questions that you're hoping to answer, if that makes sense.
That makes sense. Anybody have any further questions for Chris and Larry? So I think our next steps here for us as a committee will be that we will further discuss on this call how we want to proceed if we want to move forward. Then we will likely need to get board approval to move forward. And then we would be in touch regarding next steps with you and what information you need from us if we choose to proceed.
Okay. Great.
Great. Do you need anything from us to move forward in front of the board, or we'll hold off on our proposal until you ask for it, or we could structure that now if you'd like.
If you could structure that now and send that out, that would be great. And then I would have
Okay.
something, so it would expedite that process a little bit.
That sample analysis that you popped up on the screen too might be helpful too, just to kind of show what the deliverable will look like. And then Kathy or somebody else can kind of speak to how that will aid decision making.
The capital market assumptions I'll send as well.
Perfect.
Does a proposal with scope and fees and some of that follow-up information within the next week sound okay, timing wise?
That'd be great.
Okay. We'll try to do it
Excellent.
by the middle-ish of next week, but we'll keep you posted.
Okay, that sounds good. Thank you very much for your time.
Thank you.
Sure, it's nice to meet everybody. Thank you all.
Good to see you.
Thanks, guys.
Bye.
All right. Committee. Did that answer your questions? Blake, you've got a skeptical look.
I feel stupid. I just don't understand or see what we're gaining from this report. I'm just being brutally honest that what I heard there, I appreciated BTC's team talking about not really understanding the liability side of things. But I'm wondering, are we paying for two sides of a report when we already have one half?
Just don't know how we get the other half.
You have comments, Jeff?
Yeah, so, we've been able to provide the asset component aspect of that. We can do similar testing, what they do for the asset component. Again, what the actuary holds essentially is the liability cash flows. If we have those, we can model them with our asset. Our software does allow us to model those two together, essentially, so that the full, but again, we would need that from that ProVal system, which they were talking about, which is the actual assumptions on the liability cash flows. And then what we don't have as robust of asset scenario system as they do, is what they're talking about. And what they're talking about is running multiple scenarios in different types of inflationary environments. And like, that's that 5,000 scenario stochastic modeling component, part of the ALM aspect. We run a very similar, we run a stochastic model that does that many scenarios as well in our analysis, but obviously we don't have that for comparative with the liabilities on a scenario by scenario basis. So there's a lot we can do, but again, we would need that set of liability cash flows from those. And of course, that just involves knowing the ages of the group, what their benefit payouts are, and we have mortality rates are added. So those are the actuaries' jobs to come up with those numbers. So you're right, Blake. We can provide half the equation, but we still need those liability cash flows in order to plug those in, essentially.
Yeah, to me, it just gives us more comfort that, I think BTC can hit the target. We need to tell them what the target is and like how far away it is and all those sorts of characteristics, right? I mean, if we can get better insight into what is the optimal investment strategy for increasing all these ranges of success metrics, right? Whether it's funded status, whether it's plan participant outcomes, all these different things. I think the actuaries analysis can tell us what the optimal allocation is based on the assumptions that we'll set up in this model. So for me, I don't know, we're asking BTC to do liability driven investing with very little color on what the liability looks like over the next 50 years, which makes it harder for BTC to do their job. And so as an actuary on this committee, like I get uncomfortable that we haven't really articulated what the goal is and what the path to that goal is, and given our investment advisors enough information to, make the best decisions possible. So for me, I don't know how I've operated this long as a committee running this plan without this information already. We tried to get it 10 years ago. That didn't work out. We had great actuaries involved in the past that were running a different plan, I think, when the plan was open to actives and had a much more balanced ratio between actives and retireds that could be run differently. But we're in a new era now. And I think we need to kind of firm up what the target is for our investment advisors.
Yeah. And at some point, that consideration of segmentation, if there is an idea related to segmentation, we can separate those assets into those segment components as well. Again, we need the liability flows on each of those segments in order to be able. And when I talk about segmentation, I'm talking about active versus retirees.
I think another thing that I'm really struggling with is our role, this committee as an advisory committee, and I sometimes feel like we lack a sense of what the overall plan administrators and the school board, the superintendent, what they want, and whether our goals, objectives, and discussion is aligned to that of the superintendent, the CFO, the sort of management team and structure. And I struggle. I think that's why all of this is really hard, because I feel like we're putting three puzzles together in separate locations, and we're hoping that the puzzle fits and works. And so I don't know how to ask the question or to engage. Like, if we look at it and say, this is sort of the analysis that we want, these are the outcomes, but somewhere there needs to be a conversation. And I don't know if it's with Dr. Roberts. I don't know if it's with Mr. Aurora. I don't know if it's with School Board Chair Norris. I'm not sure who the person is, but the people who are ultimately making the decision, they have thoughts in their mind about what they want from DMTRS as well. And I feel like I don't know what that is. That seems to move all the time. And I think that I wouldn't want to do this analysis and reporting and then have there be a different desired outcome or goal from those above us.
That's a fair point, to make sure we're getting their perspective. That needs to be a consideration, I think, in the analysis. Are there questions that the decision makers want to have answered for them? My leaning, or my guess here, is that their goal for this plan is to not have to think about this plan ever, and for it to do just well enough that they don't have to think about it. And it's up to this committee, representing the actives, the retirees, and the taxpayer, to raise up the issues that could be coming from this plan. Because if we don't, they're not going to be thinking about it until there's something catastrophic that happens with it. This helps us identify where there could be issues, gives us evidence that changes may or may not be needed, and gives us some direction on how to fix them, is my thought on this.
And I would say from conversations with the superintendent, very limited on this plan, but many more conversations with Shashank on this regarding this plan. I would say Shashank's goals are to have this plan be financially stable and to not have the district have to make contributions going forward, and to allow this plan, to fulfill the obligations that we've put in place. And if we can do better by the people of this plan, would be also on his goals.
Yeah. And if our goal is to, I think, getting back to the stakeholders on the call here, like, if our goal is to improve outcomes, we can develop recommendations to do so. Where's our evidence that what we're recommending is going to make a difference, right? If we feel strongly about going to 40% for equities, the school board could just say, no, it seems risky. Where's your evidence that's going to work out for you? We did an analysis? No. Well, no, let's not take that risk. Let's keep it at 30% like it is today. Or if we get this analysis back and it says, no matter what we do with this plan, the actives income replacement ratio still stays low like it is today. How are we going to improve that, school board? Let's talk about, supplementary plans, 403B plans, increasing allocations to that. That gives us something to hold in our hands to say, here's a recommendation, here's the proof. What do you say, school board? It's the math we're doing to support a recommendation. I think without that, like, I can offer some opinions. Lucy can chime in too. BTC can chime in on what they think is best, but we're not really rolling up our sleeves all the way and doing the analysis to say what is the best thing for this plan, because we don't have the resources or the time to do that. This is how you get that information.
Well, and I think, Brad, I would chime in and say I totally agree, because we have kind of the frustrating experience from 10 years ago, but I think without this sound advice, it's kind of, we have half the puzzle, we're guessing on the other half and not really for sure how to move forward. And yes, it's a lot of money, but I think it's money well spent to get the full picture to help us advocate as this plan continues to transition into a retiree focused plan with fewer and fewer active participant members in the plan.
And Lucy, I don't know, you're in the finance area. Maybe you see some of the consultant price tags that principal pays regularly. Does $60,000 seem like a reasonable price tag for this kind of an analysis?
Yeah, I think that seems kind of in the ballpark of what you might expect given the kind of the baseline and the three other scenarios. Like you said, I know it probably seems like kind of a little bit of a sticker shock, but I do think that if we can get good direction on how to proceed in the future, it probably is worth it. It sets us up for success.
Agreed.
So what do other committee members think? Opinions on moving forward, not moving forward? I'd like to hear from you.
Philosophically, I agree with doing the piece and finding out, getting the report, using data to make a decision. I feel like that's a good move. Emotionally, I'm like, we've been down this road how many times, we've paid how much money for other reports, and they did not help us at all. We got the reports and then went, well, we just spent a bunch of money and we couldn't actually use any of this information. So I really hope that doesn't happen this time. It feels like they are trying really hard to prevent that from happening again. But it feels like we've also, at what point good money chasing after bad? But that's an emotional response, I gotta be honest. Because I think we do need the data in order to make an informed decision. I think that's the crux of the problem. But we spent this money to get the same kind of answers several times. And so that's incredibly frustrating.
So maybe
that's where I'm at.
I don't need to be talking this whole time. I don't mean to like parry every thrust that everybody makes here, but maybe one way to think about that is thinking some chess moves ahead here. We've got a plan right now. We've got a benefit we're trying to protect. What's the best way to protect that benefit and grow it as is right now? On top of that, or to the side of that, could be, okay, we have what we have. That's not enough. What's the best way to make it better? Is it changing the allocations within the plan, or is it increasing contributions to 403B? That kind of helps you choose what's the next step from there. But first of all, like, we have this plan. We haven't done an analysis with the current configuration, the current set of circumstances that we have. Let's make sure we can protect and grow what we have today the best we can. And then if we want to aim for more, what's the path forward? Is it within this plan or is it outside of this plan? Does that help kind of address some of that? Anybody else have other thoughts on that?
And Jessica, I know you're, I too understand the frustration. The last study we did, I think it's important that we all remember that that was not, a study that we selected as a committee. That was a study that was selected for us. And we tried to make the best of it. And unfortunately, there wasn't a whole lot good to come of it. I think prior actuarial studies we've done have given us little pieces and nuggets of information, but maybe not the whole totality of the picture. We've done, little ones that have guided some of our decisions, but this might give us a better full plan. And I think we all have to really, as a committee, be committed to holding them accountable for the deliverables and getting what we want out of this study.
Yeah, I was just going to say, I think with, when we are presented the results, I think we should absolutely feel empowered to push back if we don't feel like we got what we needed. Like, they're at the end of the day, they're serving you as a customer essentially. And so I think we should feel within our right to voice our, dissatisfaction if we are feeling like we didn't get what we needed.
Yeah, I think one of the things I appreciated was the opportunity for us to engage at, I think he referred to it as a halfway point. And I sort of wonder, again, not knowing what the process looks like, I do think that if we're going to proceed with this, that our engagement needs to be as frequent as is acceptable to them so that we can stop or provide more guidance if we realize that we derail. Because I think what constantly happens, and I do feel a little more comfortable because Larry at least knows our plan, is every other time we've gone to an outside person, it's taken them 3 months even just to understand our plan, right? And so, and then even then, they don't really understand it because they come back to us and we go, you don't understand A, B, or C. And so I think that Kathy, as we communicate back to Larry and his team, it would be important to say, yes, we want to have a support team of us. I would say at least an active, at least one community member, and at least one retired member to checkpoint as frequently as makes sense to them. And also to, I think, help us to have more familiarity with what we're going to see in that final report. Because even as I saw the sample on the screen, I think I understand it, but I'm not sure that I understand it. And I certainly know that being more involved in the process will help, or at least if somebody here is more involved in that process, instead of just relying on one mouthpiece to try to share and make sense, because they're going to justify and explain it because they know and understand it, and they're the ones getting $60,000. I don't want the rest of us to sit for an hour and then get to the end and go, and then leave for dinner and go, I have no idea what I just sat through for an hour. I think it was good, but I don't really know. And then we start emailing each other because everybody realizes we don't know what we just got delivered.
I agree. Melissa, how are you feeling?
I think everybody's kind of captured what I've been feeling too, just that, being 10 years into this and seeing what we've had in the past and how it didn't work out and really didn't give us any usable information. But I think it's really helpful to hear from Brett and Lucy, who are involved in this on a more day-to-day basis, saying that this would be a helpful tool. I'm also really encouraged that it is somebody who already knows our plan, because Blake Blake always says things very, very eloquently, and I appreciate that. That because we're such a weird plan, that it's nice to have somebody who already is familiar with it. It's hard, being in public education with price tags like that, but at the same time, if it is going to give us usable information, I'm for it.
Speaking about the funkiness of the plan, I'm just going to make this comment before I forget about it. Kathy, it may be helpful before they kind of dive in and roll up their sleeves all the way on this analysis to make sure they're getting excess earnings right. I picked up a little bit that there was a question around like, this is how it works, right? Around excess earnings. And so we may want to see like a couple of like really bare bones type scenarios to make sure they're capturing the dynamics of that well. And we can kind of confirm with Ben's spreadsheet that it's lining up the way that it should be. But before they go and run all the models and incur all the expenses, we should make sure that they're getting that right, because it's critical to get that right.
Okay. Yeah,
So
I'm going to
so
echo
I-
that, Brad. I said this. I was thinking the exact same thing. I was like, I go, they weren't quite sure whether actives were getting any portion of money, some portion of
Right.
money, where the
Right.
money that was not. So that was making me nervous when I'm seeing Larry. I'm like, Larry, I need you to chime in and be like, it's ABC. You should know this sequentially.
And we do those calculations. We Des Moines does those calculations, and so he may have also been kind of clarifying this scenario. He may have been sloppy with the way he worded it. I think he understands kind of how this works, but we should make sure, double check the
Yeah.
work just to make sure they're getting this right.
one other thought I have on this is it worthwhile to consider guiding them in narrowing the scope of what they may do? So let's us define what they do. So I don't know, for example, the first iteration, if it's worth looking at an equity allocation of less than 30%, because we're already there.
Yeah.
So look at 30, 40, 50 initially. Don't look beyond 50 and see what that picture tells us.
Yeah.
And then if we need to look further, then we could ask.
But I think when
But-
they said scenarios, they meant like, what's our current allocation? Okay, increase equities by 10%. That's your second scenario. Decrease equities by 10%. That's your second scenario. You're running
Okay.
5,000 stochastic scenarios on top of all of those three different allocations. You probably should have said like test allocations or something. But I think he was referring to different asset allocations as
Okay.
a scenario, but then they're doing stochastic analysis on top of each of those scenarios. That's how I heard what he was saying. It's the only thing that I can think of that makes sense.
In terms of the scope or what may drive higher cost versus a lower cost in the exercise, I'm not sure if it's more considering more asset allocations or doing more or not. But if it is, I would say narrow the possible allocations that they're looking at, and then we
Yeah.
can always widen if we think it's necessary.
Makes sense.
I mean, if the committee thinks it's necessary.
That's that check-in point will be helpful. So maybe to Blake's point earlier, we stop and check in with them after the first scenario, the current scenario. Okay, what does it look like? Does this seem reasonable to us? What's it telling us? Honestly, like if it comes out and says like, oh, this looks really good, maybe you do one more scenario after that. I ultimately think we're going to want to do at least 3 scenarios to kind of say baseline up and down, just to kind of see to your point earlier, the curve of what the outcomes look like. And then if we wanted to go beyond that, you can always do that.
Kathy, operationally, do you want this committee to make a recommendation tonight? Do you want to wait for them to, in a sense, have that base proposal and send it to us and then have us vote? What are you wanting right now?
I mean,
think
I
we should
think
get that, and we should get input from the finance leadership around what questions they want to have answered before we vote on that, and make sure the proposal is meeting everybody's needs. I don't know if it's appropriate to kind of ask the school board members what they would be interested in seeing, or what kind of questions they would want to have answered from this sort of an analysis.
I'll be honest, I don't think that any of them really have a lot of knowledge of the plan.
That's
We
fair.
lost our board member that did. And so I don't know that we have a lot of board institutional knowledge. We also don't, the new superintendent isn't super familiar with it. I think we might be best served by talking with maybe Matt, just to see if he has heard
Sure.
anything, and then with Shashank.
Mhm.
I haven't really heard anything from retirees. So Barb, Lola, Rich, how are you guys feeling about this? Are you all right with this so far?
I think it's a sticker shock for me, but I certainly understand, the need for the data. So I can swallow hard and go for it, I guess. The one consolation, the report that we got 10 years ago, I don't believe we paid for it. The district did. So
Right.
that's something.
Good point.
I'm fine with the information they passed on to us, and I think we should go ahead and get this thing done. I mean, this committee is well known for dragging its feet.
Well, how about if in the next week, they should be sending out the proposal. In that time, I will try to reach out to Matt Shashank and see if they have any additional questions, or if there's any red flags for them that they're feeling like, ooh, this isn't a good idea, or the board might need this information. And then maybe I send out that information to the group as a information that and then ask for a vote back electronically. So we don't have to reconvene, because I know everybody, this is a terrible busy time of year for you guys in the buildings. We can so we could get a vote, move forward with that. And then if it goes as a yes to move forward, I can then prepare an agenda item, and probably with Brad and Lucy's assistance there, and maybe some explanation. The board generally doesn't ask a lot of questions, but just when you think they're not going to, they do. So I need to be prepared just in case they do. Does that sound acceptable to everybody?
Yep. Good.
Okay. Well, that's how we will proceed. I will be in touch as soon as I get the information back from Gallagher on that. And thank you, everybody, for your time on it. I really appreciate it. We'll get answers coming up.
Thanks.
Thank
Thanks,
you.
everybody.
Thanks.
Sorry I was late. AP testing.
Go AP.
Yay, AP.
See you guys.
I couldn't hear you, Lola.